Okay. Okay, we're gonna record a program and I posted the recording on the library YouTube channel for 7 days. And well, I will send the link after the program to all who registered for the program. So right now we have 26 people, coming already. We got 59 people registered. So some people who cannot come for any other reason, they will still have a chance to see the recording. Okay, thank you. I'll give the screen to you, Kristen. Thank you.
That is great. And I apologize. I can't believe the whole time it was my silly, my volume was all the way down. I don't know when that happened. And please excuse my dog who seems to be having, a trauma right now. This is an amazing topic. We could talk forever. We could write a book about it. I actually am writing a book about investing. That is my next book. So I wanted to give you some insight into first of all, welcome to the Tax Consequences of Investing. Hopefully you're in the right place. And we will do our quick legal disclaimer that this is for educational purposes only. And we are absolutely not giving tax advice. Do not make tax moves based on what you hear today. And then also we mention a lot of investments, but we're not mentioning them because we're recommending them. We're not mentioning them because we think they're suitable. So please just take all of this information as educational. It is not specifically for you. And if you want to start making some investing moves, please consult a tax expert. Okay, so I just started putting together this collage in the past month when I was thinking about, what is really critical with if you're going to be investing and you might not be so mindful of the tax consequences. There are very serious tax consequences when you invest. I just started putting together this collage of things of like, okay, Kristen, don't forget to mention this, that there are all these sort of surprises. People don't know the wash rule and they don't know that gold is actually taxed like a collectible. So they're not going to get that precious 15% capital gain. They're going to get hit at 28%. There are all these things going on, and where you live matters, and how long you own the investment matters, and what kind of investment is it? That if you think of your house as an investment, that's treated so favorably because the government's trying to encourage certain behavior and not other behavior. And I just started putting together this collage, partly to give you a sense of just how vast this topic is, how difficult it is to tackle, and how mindful you should be that as you venture into investing, you should definitely be aware of the tax consequence, and that's probably why you're here. And you should definitely be telling your nieces and nephews and children who are going on to Robinhood. Trust me, I know, I wrote money in your 20s. They are just opening a Robinhood account like it's nothing, and they're just buying stuff without much thought. They have no idea about that their taxes are going to be gained, their gains are going to be taxed. I had that backwards. They have no idea about the wash rule. They have no idea about tax loss harvesting. So here is the mind of someone who's trying to think of all the things that are important to say. And it's kind of a mess, but I promise you that I really have tried to drill it down into something really helpful that we can cover in an hour, that it will be organized. There will be big themes. And I'm really interested, as I do this, since this is a discussion group, about your thoughts, because there's a ton to cover. And however you think you can be helpful to other people in the group, or any unique stories you have, stories are great, and usually like the painful stories are the best. I'm gonna share one of my wins and one of my losses, definitely. But this is kind of where I've drilled down. I'm just gonna quickly check the chat because I see there are two things. Oh, okay. What's in the chat now is just from Young Wong, who runs the programming, saying that you can kind of interrupt at any time. Okay, so this is kind of where I come out with how are we going to make this a productive hour on a topic that could fill an entire book. Okay, somebody out there needs to mute. I don't know who it is, but or Young, maybe you could figure out who it is and mute them. But this is what we're going to tackle.
I think anyone who want to talk, they can unmute themselves.
Oh, I thought that was sort of background noise, but do you think somebody wanted to talk?
No, I don't see. If they want to talk, they can unmute themselves. I just mute everyone when you are talking, so the recording would be better. But if they have a question, they can anytime they can unmute themselves.
Oh, perfect. Okay, great. So you have everybody muted, and
Yes.
so I don't know what that funky background noise was, but then people should unmute themselves when they want to talk. So here's how I've thought about organizing tonight. You know, there's so much going on, so many moving parts with taxes and investing. So let's just go like sky high. Let's look at the view, you know, from 10,000 feet in the air. What are the big themes and what are the big ideas? What are the takeaways? And, you know, the very first is that, you know, whatever you're investing in, whether it's your home, your business, cryptocurrency, a stock, a bond, you know, you're putting money in, and that's creating a basis. So there's going to be this basis of what was your original investment. And then somewhere down the line, you know, you realize a gain by selling. You don't realize a gain by sitting on an asset. Almost all the time, except, you know, when it comes to tax rules, there are always caveats, and there are these crazy like futures, you know, if you trade futures and commodities that are marked to market. I mean, anything I say, you could always find, well, that's not always true, but you know, 99% of the time for the average investor, we're looking at realized gains. There's a basis later on, there's a sale, there's been some increase in the investment. And now it's like, well, what happens next? And the big ideas I want to offer, sometimes there's no tax at all. Sometimes there's a relatively low tax, and sometimes there's a high tax. And it's really important that you understand, if you're trying to minimize taxes, you know, how does all that work? Like what creates a low tax? What creates a high tax? What creates a no tax? So what are the key factors, right? So there's what happens, there's like no tax, low tax, or high tax. Then what are the key factors? Like, you know, the government absolutely creates laws around, you know, favored behaviors. So if you're kind of participating in a favored behavior, you're going to have a better tax situation than a non-favored behavior. Timing has a lot to do with things. Location, you know, on the state level, there are states that are punitive with taxes and states that are favorable with taxes. So these are sort of the big takeaways that I'd like to cover. And then also at different points, I'm going to pause and definitely ask, you know, what's going on for you, what seems right for you. But I just want to get but also put some ideas out there to get the conversation going. And, you know, I also definitely want to help at the end, help you avoid common mistakes. I've made a bunch of common mistakes. I had no idea what the wash rule was when I first started trading stocks. Very embarrassing. But, you know, I was in my 20s, nobody told me. And then, you know, my main takeaway, and I think we'll all come to this conclusion at the end, if you have, you know, a lot on the line, if you're going to really go into investing, get a good tax advisor. Okay. All right. So here we go. So the first big idea is that you can invest in something, you can sell it for a gain, and depending on a number of factors, you're either going to have no tax, low tax, or high tax. So how is that happening? I would think most people here want no tax or low tax. So let's look at the first, the no tax. And hopefully a lot of this is review, but the government is definitely, you know, creating laws and scenarios where you are rewarded for doing things that the government thinks is very, very helpful. So for example, saving for retirement. You know, if you read about the history of Social Security, the entire history of Social Security is that there was this crisis of elderly people being absolutely flat broke at a time when, you know, in the country, like people weren't living on farms anymore. You know, you weren't necessarily living near your parents. So the children of these elderly people had all scattered, and these elderly people were broke. And this became like the elderly population was like the most poor population. And then voila, you have Social Security, and all of a sudden the elderly population is nowhere near that. And sadly, there are other populations that are like in much, you know, in terrible trouble. But this whole idea of Social Security was put in place, but also saving for retirement was put in place as something we absolutely value. So, and this doesn't mean there's never any tax, but there are tax shelters around retirement, like the 401k, the 403b, the IRA. So as you earn money, you can funnel your money into those tax shelters. And for some of them, not the Roth, but for some of them, you literally you take that money and it's not even counted as income for you for that year. So if you understand progressive taxation, then you understand that those top dollars are getting taxed at the highest possible rate for you. And so you're actually taking those top dollars and shifting them into a tax shelter and not getting hurt with that top rate. We're going to talk more about progressive taxation later. And if you don't understand progressive taxation, that is absolutely your first stop to doing better with investing, because progressive taxation, understanding it, is a prerequisite for understanding investing and tax consequences in general. And I will go over that. I'm just going to check the chat for 1 second. Let's see. Okay, let's see. Is there okay, I do not see a new question. Okay. Or was that a raised hand? Okay. Any case, so there are tax shelters, right? So while your money is inside these shelters, whatever gains you're making are not being taxed, even if they're realized gains. So you can buy a stock, you can sell a stock, you can own a mutual fund, you can sell a mutual fund, you can make dividends, you can have dividends on the stocks or the mutual, you can have all these things, and none of it is being taxed while it's all inside the tax shelter. So, and these shelters also, there's, the 529 is because we really, really favor education. So now when you go to take money out, there's a huge amount of tax law about that. And I get questions about this all the time. And I'm the money in your 20s lady. That's my book, Money in Your 20s. I'm like, I am no expert on the required minimum distributions and whether or not they were halted because of the pandemic and things like that. But boy, do you need you need some tax help. But while your money is in these tax shelters, your gains, you're not paying taxes on your gains. And then if you're like in a 529, because we value, the government values people getting educated, if you take money out and it's used for educational purposes, you're never taxed. So that's pretty awesome. I have a little picture of a house, because we also know that if you buy a house and it's your primary residence and you live there for 2 years and, a few other rules, that when you go to sell that house, you're actually forgiven. If you make a big gain on the house, you're forgiven a lot of the gain. So that's another area where it's just the government favors certain behavior and discourages other behavior. And now location, hopefully most of you have considered this, but there are certain, areas to live in the country that are very, very tax friendly. And there are other areas to live in the country that are very, very tough on taxes. I know people like to beat up on California, but I got to tell you, since I have 2 kids that need to be college educated and college is running about $80,000 a year, you can beat up on California, but maybe I should have moved there 5 years ago. I mean, if you can get the California system at in-state prices, everyone's situation is different. So I personally am not going to beat up on California, but they have the highest marginal tax rates in the country. So if you're going to go the no tax route, you're going to be in tax shelters, you're going to live in sort of these no tax states. You're going to buy certain investments that as they gain or as they, have interest payments or dividends or things like that, it's not being taxed. There are all of these things that you can do if your number one goal is to avoid tax, to understand what investments, like muni bonds or Series EE bonds. Again, Series EE is because we really favor education. So if you buy those bonds, they're not taxed if the proceeds are used for education. So it's kind of learning the system of like, okay, what is the government favoring? Where should I live? What should I buy? And these are just sort of interesting rules. I mean, I'm obsessed with this chat now that I haven't found Oh, okay. That somebody's just sort of losing connection. Sorry. You will be able to watch this later. Okay, so let's move on to just a little charitable giving story. Another thing that's very, very, very tax favorable is if you decide to be generous. So you can make a huge gain and just give away the underlying, just if you buy a stock and it's raced ahead, you can just give it to a nonprofit, give it to a church, give it to the Red Cross, give it to, whatever you want to do. And that's fabulous because that entire gain gets absorbed. It's a great gift and the entire gain gets absorbed. So there's no tax consequence for you. The fun story I wanted to tell though, is once I really started to get in the groove about the tax consequences of investing, I had kind of fun because I was like, ooh, like I love picking stocks. I know we're not supposed to do that. Anything you read tells you can't possibly beat index funds and blah, blah, blah. And maybe that's true in the long term, but I love picking individual stocks. And then if they really take off, I love giving them away because, for example, this gal who helped me for years with car rides and dog walks and things like that. She was a student at UConn Stanford, just wonderful, wonderful gal. Her graduation was coming up and I was like, oh, wow, I bought Build-A-Bear during the pandemic when people thought, no one was ever going to go to the mall again. I think Build-A-Bear was like $2 when I finally bought it. And it, I think today it's probably in the 13s. But in any case, I captured this enormous gain in a short period of time, which I personally can do nothing with. If I sold and realized the gain in the short term, I would have an enormous tax consequence. So the fun thing for me is to give it away. But I don't, not give it away to charity. Go to someone like a student who's, got student loans, financial aid, whatever. They have no, income other than like the dog walking and the babysitting and things like that. And just tell them to open a brokerage account and transfer the stock to them and then have them sell it immediately. And then that person basically has no gain. Even though it's a short-term sale, that person has no gain, but boy, are they excited with the gift. It's like, maybe you would have given someone a $300 gift, but you can give them a $700 gift because the stock just took off. So it means so much to them. It doesn't mean that much to you. And the tax gain just disappears because that person is not even meeting the standard deduction, basically. Or maybe they are, but that's not in income that anyone's going to find out about because dog walking and babysitting is not really happening on the books. This is being taped. I probably shouldn't say that. But in any case, charitable giving, another great way to have no tax, and you can get creative with it. I love the idea of taking something, I've done it several times, where I buy a stock, I get someone, they open a brokerage account in no time. It takes no time these days for them to open a brokerage account, and then I just transfer it to them. I'm so missing Young Wong being here. Let's see.
I am here, Kristen. There's one question at the chat box.
Okay, as stocks are low, is it best to invest now or wait almost to the end of the recession? Okay, so this is the part where, it's actually illegal. I have to be careful. I should not tell people to buy stocks, certainly not specific stocks, but I just want to give you an idea, okay? Especially if you have like a niece or a nephew, a young person in your life whose income is so low, they can get a Roth IRA. This is what I'm doing with some of my young, the people that I counsel now. It's like, this is interesting. You buy something inside a Roth, you will never pay, or not you, because a lot of the people I'm talking to, their incomes are above, they don't qualify to have a Roth. But a young person can open a Roth, and there are so many stocks right now that have just gotten destroyed, really destroyed. There are $1, $2, $3 stocks of good companies, and you should do your research. But say that person buys 50 shares of a $2 stock and it goes up, 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 up. They never pay tax on it. Never. It's just fascinating. So for someone like me who just loves individual stock investing, it's hard for me to just sit on my hands and not like jump up and down, but I got to be careful because, you know, also you could just lose all your money. I mean, you know, all these stocks that are like $2 or $3 or $4 are, you know, possibly going to zero. I don't want you to be mad at me, but, you know, there are opportunities out there. The Roth is an extraordinary opportunity in my mind for someone to get in on the ground floor and then never pay for the gain. The one thing to keep track of, though, is if that person sees the gain and then they kind of want to like, ooh, I want to do something with this because they're young and not patient, they can only withdraw the amount of their original, what they originally funded the Roth with. So they have to be careful. You're not allowed to pull out any of your gains from a Roth, but there are a bunch of ways to pull out your initial investment. The Roth is very loosey-goosey with that. But, you know, do I say like, you know, buy when the crisis is over? No, the only time to make money is to buy during the crisis, but that's when you have to, you know, really know what you're getting yourself into. It's buy low, sell high. When everyone's panicking, that's the time to buy. But, you know, no, it's your risk. It's your, you know, what can you lose? When do you need the money? All these conversations. So, and I just have to be careful because I'm representing the library too, and we don't want to be giving you any crazy advice. Okay, so charitable giving, obviously, again, no tax consequence. Okay, so what are the situations where it's not no tax, but it's some tax? Okay, so now you're investing outside of the IRA or the 401k or whatever. You're just investing, you know, your ordinary money, but you don't want it taxed as ordinary income. So that really, and so, you know what, spoiler alert, let's just move ahead. So like you should look at long-term capital gains. If you've never taken the time to realize how low long-term capital gains are, now is the time. And you should sort of weigh in with like, you're comparing it to what? Well, you're comparing it to how you get taxed at, you know, at ordinary income rates. So ordinary income rates are much worse than this, except for the absolute lowest earners. So, you know, we have 7 tax brackets. We have, well, I mean, they don't count zero. I don't know, but, you know, if you only work through your standard deduction, if you basically don't work at all, you're going to have income but zero tax, because I think the standard deduction for a single person is $12,950. So, you know, if you just sit on your parents' couch and don't work at all, you know, you're not even going to get taxed. But then like 12,950 plus $1, you're starting to get taxed at 10%, and then you get taxed at 12%, and then you get that big bump up to 22, and that's when it starts to get interesting. So once you're at 22%, that's when all of these long-term capital gains, you know, not all of them, but most of them are lower, except for that top 20%, which really only the super high income people are paying. So here's this, you know, who's paying the sum tax? It's the people who are making gains, and they're making sure that their gains are taxed at the capital gains rate and not the ordinary income rate. And, you know, I would love for someone else to weigh in, but all I see all the time is this is really based on, you know, someone kind of messing up and selling an asset, you know, in a term shorter than a year. So it's like short-term gains, anything shorter than a calendar year, you get slammed with, you know, these sort of short-term, the short-term rate is your ordinary income rate. And what you want is the capital gains rate. So here, I'm going to jump ahead. Here's a slide sort of comparing the capital gains rate, which is either 0 or 15% for most people, versus, you know, you don't have to earn that much in ordinary income to start getting taxed at 22% or 24% or 32%. And if this doesn't make sense to you, then you need to email me, and I will send you for free the chapter of my book, which is Taxes 101. You really cannot navigate life as an investing adult if you don't understand tax brackets. Nobody taught it to you. There's no shame in not understanding, but you must understand that we have 7 tax brackets. The more you earn, the greater percentage you pay, the more you earn. So you're going to pay 10% on a certain amount, then 12%, then 22%, then 24, and it just keeps going up, 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 all the way to 37%. So what you're trying to do is avoid, if you know that for capital gains, for most people, you're getting either 0% or 15%. You compare that to, let's look, a 32% rate is, any income for a single person over $183,000. Well, you have to get all the way to like $490,000. You're still in the 15% rate. So it's literally double. I'm just going to check this one chat. I need the book. Oh, that's very nice. Yes, please get the book. I love it when people read my book. But definitely email me if this doesn't make sense to you. Email me and I will send you for free the Taxes 101 chapter. I'm kind of on a mission. It drives me crazy when people don't understand taxes. They look at their paycheck, they think they're only getting taxed at 25% because they don't understand that those last dollars they're earning, if they live in New York City, honestly, you don't have to earn that much, only $55,000. Every dollar after that is getting taxed at 40%. It really, really is. That's the scary.
The library has the book too, so check the library catalog.
That's right. And the library has like 3 copies, I think. So that's good. Okay, so the high tax thing is if, heaven forbid, you realize a gain, and if you are in a relatively high tax situation and the gain bypasses capital gains tax rates, so our nice capital gains tax rates, you're going to pay 0 or 15%. The majority of people are going to pay 0 or 15%, but somehow that didn't happen for you. You did something short term, and so now you're facing 22% or 24% or 32%. Ugh, that's like bad, bad, bad. Or, you also live in a very, very high tax area. And again, I'm not slamming California because, hey, if you've got kids to educate, I think California is a great deal. But, if you don't have kids to educate, I'm not so sure. Okay, so we are high tax. We've talked about, this situation. Now, and, email me if you want the free chapter. If you have been listening, who can explain, based on what I've said, like, what is this, Warren Buffett comment, this billionaire saying that he pays less tax than his secretary? Anybody want to take a stab at it?
You would only recognize the tax if you're selling the asset. So he's not selling the asset, he would be holding for the long term. That's
part of it, but he is selling. But why is he still paying less?
He's paying capital gains tax, not ordinary income tax.
Right. And do you think you could like nail the number that he's probably could you compare, like, I bet he's paying this rate and his secretary, male or female, is paying this rate? What would you guess?
He's paying 0 or 15 because he's planning and he's holding the assets for longer. So he's paying long-term capital gains rather than short-term.
So my guess is that I wonder if he's really getting away with only paying 15%. I don't know, but let's say he is. But okay, because he has these assets and he's selling them, and maybe he's only paying 15% at the federal level. But you would think that anyone who is an assistant to Warren Buffett is making a really, really good salary, right? So I would think that that person is definitely in the 24% bracket, possibly in the 30, those top dollars are even in the 32% bracket, because it's not unheard of. If you're the go-to person, the right-hand person for Warren Buffett, maybe you are making $200,000 a year. So, it's kind of this interesting idea that those top dollars are just getting slammed. So is it possible that Warren's only paying 15%, but his assistant is paying 22%, 24%, 32% on the top dollars? And then when you look at the whole picture, they're above 20%. That would be my guess.
My guess is he's paying the maximum for the long-term capital gain rate, that is 20%, while his secretary is paying 24% or more for regular income tax. So he's paying
that makes more sense to me,
Yeah.
that he's paying the 20%, because he still has a very nice lifestyle. I think he's realizing more money. Yeah. But
I think he means by percentage, not exact amount. He's paying 20% while his secretary is paying 24%. I think that's what he means.
Yeah, I think you're right. I think you're right. But it was a compelling thing to say. And at the time, I mean, well, also, I don't know if you've noticed that people, when people say that the rich don't pay taxes, they really have very little understanding of who's paying taxes. So the difference between wealth, like high income people actually, in my mind, a flaw in the tax system. Young, can you mute? There's this weird background noise. Maybe you could mute everyone again. Young. Oh, thank you.
I'm muting other people now.
Yeah, there's just this weird, some weird background noise, but I think there's this misconception that, if somebody has a really high income, they're wealthy, but we all know someone who grew up poor, struggled, they took out a bunch of loans, they finally got out of law school, or they finally got, started in a business, or they're finally on Wall Street or whatever. And sure, they're making like a really big income, but they actually have no savings, no assets. Their net worth is negative because of the student loans, but those poor creatures get destroyed by taxes. And it's just so not fair, really. That's not the way the system was set up, to take some person who's burdened, who has, not from a wealthy family, had to take out student loans, has no assets, and they actually don't even get to deduct their interest on their student loan because they exceed some income level, but they're basically like really not, they're just starting out. And my heart goes out to those people, because I don't think that was really how this thing was supposed to be set up. Hopefully you guys know what I mean, but it really bothers me when someone has a big tax bill and they have a negative net worth. And meanwhile, people who, maybe their parents like paid for everything and gifting them stuff and starting them out with so much, and, but they have a lower income, but, so they don't pay much tax. I mean, the system is not perfect by any means. Okay. So let's circle back to, we had these sort of big ideas that there are gains, and it's really important to understand that there, whatever you're in, whether it's cryptocurrency or stocks or bonds or housing or gold or whatever, there's this initial price you paid, and that's your basis. And one piece of advice: get organized, because especially if you buy a house, your basis is a moving target. As you buy things for the house that are legitimate improvements to the house, not curtains, right? But if you do things to the house to improve the value of the house, you actually increase your basis. So it's as though you changed the purchase price of this asset. And that's really important, because then when you go to sell, you're going to want an increased basis. You're going to want a larger basis so that the gain is smaller. I mean, maybe a house is a bad example because you can, you don't have to pay. So, I mean, if you're married, like $500,000 of the gain is deducted. But basically, you want to be really careful with your basis. So you're back when there was commission, no commission-free trading. Even when you bought a stock, you wanted to say, okay, well, yeah, I bought that stock, but the commission I paid to buy that stock is actually changing the basis of the stock, so that when I go to sell it, I don't want to pay tax on a gain that isn't really a gain, because I had fees, transaction fees, to capture the stock and to sell the stock. So this concept of basis is really important, and being organized around, like, keeping track of your basis and make sure you never overpay based on your basis. And then, the whole no tax, low tax, high tax, I think we covered that well. hopefully you guys have a sense of the key factors. And please, if I'm forgetting a key factor, I mean, location, timing, favored status by the government, by the IRS. Anybody want to chime in with something else that seems to really move the needle on? Yeah, I mean, there's so many little things of, like years ago when we were trying to develop Puerto Rico, anyone who'd start a business in Puerto Rico was given like a really favorable tax treatment. But if I'm forgetting something obvious, please chime in. Let's see. Nick, am I forgetting something obvious?
There's another thing that I would add as a tax alleviation strategy, and that would be opportunity zones. So that is something that enables you to invest a gain, especially taking your scenario of a short-term gain. So if somebody did sell a stock accidentally within that first year and recognize a short-term gain, you can invest that capital into an opportunity zone, and that could be real estate or an operating business. And that would enable you to defer your taxes until 2027. And then there's an additional benefit. If you hold that investment for a period of 10 years, any future appreciation is completely tax-free. So it's a very good tax incentive that was generated back in 2017 to 2018. So it would fall into the pay less tax or pay no tax initially bracket. It's a separate investing strategy, but something for people to consider if they did recognize a short-term gain and they don't want to pay that higher rate.
Oh, that's really interesting. So are opportunity zones bad neighborhoods? Like, what is an opportunity zone?
Yeah, they were based on the census tracts back in 2010 through 2011. So they were low income neighborhoods, but there are a number of areas actually that were designated as opportunity zones that are good areas to invest in. There are a lot of very bad ones as well that you wouldn't, as a real estate investment, parts of, Chicago that you probably wouldn't consider investing in. But there are some across the country that you'd be surprised that they're opportunity zones. They were set by, the local governments and municipalities decided where they were. There are some in Connecticut as well.
So do people get into them by going into a REIT?
You can, they're often structured as opportunity zone funds. So they wouldn't be a REIT, they would be a specific fund that is created, with a CPA and attorneys that would put together an offering. So it wouldn't be a REIT, it would be an alternative investment to a REIT. But,
and anyone can do that, or only an accredited investor?
Often accredited investors. There are some transactions that I've seen. There's one that's a publicly traded stock that I've looked at. So mostly accredited investors, but there are a few that I've seen that would be open to non-accredited. Oh,
that is so interesting. I got to write this down because I love learning things. And you hear about opportunity zones, but it just doesn't seem like something that's actionable. But it would be really interesting if it's actionable for, regular people,
Definitely actionable. And the difference, there are other tax incentives investing in real estate. Another option is a 1031 exchange. The beauty of an opportunity zone is it could be the sale of any asset. It doesn't have to just be real estate. So it could be sale of artwork, sale of stock, sale of a business. I've seen situations where people have sold businesses and then they've rolled over the gain component into opportunity zones and they're deferring paying that tax. And as I said, if they hold it for a 10-year period, that beauty of if it's a good investment is completely tax-free. So you can, if you're picking a good place to invest, you can make a lot on the back end as well.
Do these opportunity zones operate almost like bonds, like they're promising you a certain specific payout?
So some will be cash flowing, some will be predicated on a development. So it could be a real estate development, and then the gain would be recognized, or the investment would be recognized at the end of the 10-year period when the property is sold, maybe to an institutional buyer or somebody that would come in and buy the property on the back end. Some of them, though, if they're have generating cash flow, they'll pay distributions, and often those distributions can be offset against depreciation, so they'll be tax-free as well. And then because it's an opportunity zone, you don't get depreciation recapture on the back end. So it can be, as a tax planning strategy, OZs can be very good if you have a good deal. So you need to be very careful about the the deals that you're investing in, because as I said, there's some areas that you wouldn't ordinarily think about investing in, and people sell them on the basis that they're opportunity zones, so they must be great. But if you pay zero tax on zero as a gain, then it doesn't work out and end up being good investment. So you have to be very careful and select good opportunity zones and do your due diligence, but it can be a very effective tax planning tool.
We also, remember last month we had this gal, I think her name was Pamela, and she was into socially conscious investing. I mean, there's sort of a feel-good aspect of opportunity zones if you're reclaiming a bad neighborhood.
And that was the intent of them, was to generate revenue and to increase economic activity in the areas that you're investing in. So that was the intention of putting them in place in the first place. So yeah, you're right. There's an ESG component to them.
That's really cool. I don't know if Pamela, I think her name was Pamela. Anyway, if you're here tonight, Pamela, say hi, or tell us if that's part of the social. I don't know. It might be too far afield for the, what is it? ESG, environmental, social. What is it? Environmental, social. All right.
Governance.
And what is it? Governance. Thank you. Governance. Okay. All right. Great. So we have. Yeah, another key factor, the opportunity zones. What do we have left? Let me just check the chat one more time.
Somebody make a comment, say the book Invest for Better is very good. I don't know the book. I don't know.
The book Invest for Better. I'm actually writing that down because I don't know what happens when you tape something. It doesn't mean that you can access the chat again, right? I think the chat disappears. But
You can, if you exit the full screen. I saw you first use the full screen. If you exit the full screen, you can see the participants, you can see the chat.
Oh, okay, good. Okay, so before we run out of time, I do want to make sure that we cover everything. So we still have kind of common mistakes. And these mistakes, I think I can't say enough about how not all these rules with the IRS are intuitive, and and nobody tells you this, nobody teaches you in school. So when I first started trading, I had no idea that short-term gains were taxed differently than long-term gains, that holding something for a year had any meaning whatsoever. So that's a very common mistake. The wash rule actually makes some sense, that you shouldn't, if you sell something for a loss, if you say a stock, you sell it for a loss, and you're going to, use that loss to offset other gains, you should only, if you own many, many stocks, it's not like you only pay tax on your gains and then the losses are forgotten. You're able to, at the end of the year, look at everything you've owned, and you pay for what you've gained, but you can offset your gains with other losses. But you can't do that if you own a stock, you sell it for a loss, but then you repurchase it in 30 days. And the rule is actually even more confusing than this, but I'm not going to go into it. It's something having to do with 60 days and 10 days before you sold the stock. If you bought a stock very similar, I'm not going to get into that. But let's just say you sold something for a loss, but then you missed owning the stock, or you became fond of that stock, or you thought it's definitely going to rebound. I regret selling it, and you purchase it again. You've now triggered a wash rule, so you can't use that loss. I had never heard of that. I mean, that's very important to know. I had never heard of it. I'm just going to quickly check the chat again. Oh, opportunity zones are not for this audience. Please use time well. Okay. Got it. Well, we are moving on. Okay, so short-term, the big takeaway, the most common mistakes in my opinion are, like, you have no idea about short-term gain versus long-term gain. You have no idea about the wash rule. And then you just have no idea that weird things can happen. Like, a lot of people think, especially since gold is an ETF, that it's fun to invest in gold, or it's, you can invest in gold. It's very accessible. But gold is not taxed like everything else. It's considered a collectible. There are ways to get around this. So if you're interested in sort of making a bet on gold, you can Google like how to not get taxed at 28%, even when it's a long-term gain for gold. But this is one example of, like, you're sitting there, you think you understand how it all works. You think you want to get capital gains rates, you want to be at the 15% and not higher. And then you come to find out that you bought the gold ETF and now you're on the hook for 28% if you make a gain. Yeah. So this really leads me to my final point, is how to select a tax pro, because hopefully this evening has taught you that you don't want to be venturing too far, especially with a lot of money, without having at least someone to consult. But I will say the one problem with hiring a tax pro is if you think you're going to do that for someone to help you at the end of the year, because what you want is a tax pro that you can talk to and say, how am I going to mess this up? You don't want the tax pro, like she can't fix your problem after you've already messed it up. So you want someone who's going to have a dialogue with you about tell me what I might do wrong. If I'm going to start moving this money around, tell me what could go wrong or what should I do? That's that kind of proactive tax pro. But tax people are not created equal. Okay, what about shares in gold stocks or gold ETFs? Okay, my understanding is that's still treated as physical gold. But again, I'm not a tax pro. But there are absolutely ways to get around this. And if you Google it and you want to make a bet on gold, I've seen this is how you get around the 28%. But you're going to have to figure out that for yourself. Definitely physical gold coins, things like that. Definitely 28%. Okay, how to select a tax pro. Anyone in America can claim to be a tax pro. So some people find this surprising that anyone can put out a shingle and say, I can do your taxes. And they can, it's fine. But if you're really trying to find someone legitimate there, and again, this is in chapter 10 of my book, it's called the chapter is Managing Success. So for those kids that, the 20 somethings who took mom's advice and went into a STEM field and, their job offer after college is 80,000 or more, they actually need to start getting into some sophisticated tax advice, right off the bat. So in that chapter, I explained this is how you, vet a tax pro. And one of the things I want to point out is there's something called the Preparer Tax Identification Number, PTIN. And if you're legitimate, if someone's claiming to be a legitimate tax pro, they have this number, and you can go to the IRS website and you can vet them, you can enter the number, you can make sure that they are registered with the IRS. And that will basically get rid of, 90% of the scammers out there, I would imagine. Just by having this number. It's called the Preparer Tax Identification Number. So you want someone who's legitimate and is known to the IRS. Another thing is, if you're really sophisticated, if you're starting to, be someone who might get audited, you only want to pick a tax preparer who can represent you in front of the IRS if something goes wrong. So those people are tax attorneys, CPAs, and then there's something called, what the heck is it called? An enrolled agent. Okay, so an enrolled agent can also represent you in front of the IRS. But those if you just want help getting your taxes done, the person who has the tax preparer number, you can find them on the IRS website. They're legit. That's one thing. That doesn't mean they can represent you in front of the IRS if something goes wildly wrong. Then you need that higher level of the tax attorney, the CPA, or the enrolled agent. And I think, again, that's all going to be they can prove their credentials and things like that. So, and you can check it out with the IRS, but I would definitely go in that route. And hopefully tonight, you've seen why you might want to do that. The next thing, oh my goodness, my battery is running low. I hope we're not going to get cut off. The next investing discussion is fun with financial statements for all you geeks out there. We're going to do it. We're going to plow through and we're going to look at those annual reports, but we're going to make it fun because I use the annual report from Krispy Kreme. So we're talking donuts and coffee and equipment and things like that. And that is Tuesday, November 1st. And if you have any questions, you can always email me, kjacks@moneyinyour20s.com. I would so appreciate it if you would follow me on Instagram, because when my next book comes out, I really will have a much better time with you know, various things if I have more Instagram followers. So anyone who can follow me on Instagram at Money in Your 20s, that would be great. Hopefully we're not about to get cut off, but if anybody has any questions, you know, we can just go back through, I think this slide of looking at all the horrible things that are out there, you know, whether it's cryptocurrency or bonds or stocks or housing or whatever. If you have a question, add it to the chat, raise your hand or just speak up. Cryptocurrencies are actually really interesting right now because they haven't been that well defined. But I would be very, very careful with cryptocurrencies because the IRS is watching them, but where you trade cryptocurrency, like a Coinbase, they're not obligated to give you a 1099, which sounds very fishy to me. So how are you, you're gonna end up with some kind of tax liability that you can or can't prove. Okay, what's progressive taxation? So that's how our income system works right now. So when you make money, when you have income, you don't just get one flat tax rate, right? So say you're making $100,000. You don't have a system where you're just going to pay 20% in federal tax. That's not how it works. Our system is so confusing. The more you earn, just imagine like all of your dollars are laid out in a row. And you know, like the first 20, I should try to be more exact because I almost know it off the top of my head. The first $12,950 you earn, no tax. Okay, put that to zero. That's called your standard deduction. Then after that, the next about 11,000 of those dollars that you earn, you get taxed at 10%. And then after that, like the next 40,000 that you earn, give or take, you get taxed at 12%. And then after that, this next huge chunk, you get taxed at 22%. Oh, did somebody say something? Anyway, it's really, really confusing. These are all these tax brackets and all of the money you're making is getting like put in these different buckets and some of it's getting taxed at 0, some of it's getting taxed at 10%, some at 12%, some at 22%. And then it goes up, up, up. There are 7 different brackets. And then finally you're at 37%. And you have to remember, this is just federal. So you still, and God forbid you live in California, you still haven't paid your California tax, which is also progressive. So in California, they're going to tax, you know, the higher dollars at the highest rate. Oh, Claire, are you a tax expert? Do you want to weigh in? Claire, I saw you come on board. Oh, I thought maybe you had something to weigh in. Anyway, that's what progressive taxation is. It's sort of the opposite of a flat tax. And it's considered progressive. Where did they get this language? Regressive is, you know, when you have a flat tax, it's like, it's considered that the lowest earning people are getting kind of hurt the most. And so shouldn't the people who earn more pay a greater percentage the more they earn? And that's considered progressive. That's that whole story. Great question though. Anybody else looking at our little collage of, you know, wash rule basis, collectibles versus commodities. I personally have never traded a commodity in my life. I thought I did because I thought gold was a commodity. It's not. I've never traded it, but apparently it does have unusual tax rules. If you trade commodities futures, it has really unusual tax rules. Anything else? Anyone else? All right, well, I hope you guys join us November 1st, especially all the geeks out there. If you really want to drill into, please talk about the book, How to Speak Money. I just love this guy's book. I think John Lanchester, I can't see it because of the face boxes are covering it. The point he was trying to make is that, like, you should not be intimidated that money is so confusing, because one really weird aspect of money and the language around money is that it's not intuitive, right? So a hedge fund doesn't hedge anything necessarily. A security is not secure. It's almost like we chose language that,
Okay, I'm sorry. I think Kristen really has no battery. So thank you everyone for coming, and I hope we can see you again on November 1st. Okay, thank you and goodbye.
Thank you.